Thank you, guys. Welcome to Bloomberg. Thank you to our panelists for being here today. The topic of our discussion today is financing the ninth inning. Are we on borrowed time? So let me begin by saying that when I joined Bloomberg 5 years ago, I thought I was joining the corporate credit desk to cover the next credit crisis. It took me about 3 and a bit years to figure out that what I should be doing is covering M&A because the credit crisis wasn't coming, and I'm better off focusing on the boom. Susie, my first question to you, where do you see this going? What's your pipeline look like? How long can the financing boom continue?
So in talking about M&A financing, I think the M&A markets are still really robust. We've had some bumps in the equity markets, which might slow down dialogues. But we've rolled into this year in a very, very strong way. We've had a number of big deals announced. We've had a number of smaller deals announced. And the financing markets are wide open to finance M&A or regular way financing for the highest rated credits, right down to the lowest rated credits. So for now, we expect this to continue, but there's some headwinds out there.
Yeah, we've had 7 years of consecutive $1 trillion years in the investment grade market. We've got a chart over here that shows that this year we're about 12% down. How do you see it recovering?
So most of the reduction in issuance is around big M&A financings. In fact, the flow business is actually up slightly this year. And so from a volume perspective, we actually don't see it recovering because given that it's June, we'd have to have some mega deals announce, bridge, and then price in the bond market to get to flat. So I think we'll be down slightly this year, but with regular way issuance up. And you sort of wonder with the rally in rates, and then credit spreads are slightly wider, but not as much wider as rates are, if some folks might jump into the market and pull forward 2020 financing.
Is that what you're advising?
That's what I'd be doing. I'm looking at refinancing my mortgage, so.
Good time to do it. Alex, I'd like you to jump in here. One of the reasons this credit boom has continued so long is all of these different pools of capital that are available. I know that at EQT, you guys have been users of private debt. You just did a big deal financing for Zayo recently. Could you talk to us about how that's changed the way that you're doing deals?
Yeah, I think it's one of the more interesting trends that we've seen over the past 15 years. The capital opportunities that you have are much broader now than they were in the past. Part of that has been driven by the private capital that's available on the financing side specifically. And the way I think about that as an equity investor is it gives us a lot more flexibility, for one thing. So if you look at the flows of capital generally, there's $1 trillion that's basically gone into the private capital markets over the past decade or so that is available to equity investors. And it doesn't mean that it is necessarily cheaper, but when you're looking at the alternatives that exist out there, it's a lot more flexible a lot of times. So just as an example, we've recently used it in one of our companies where we started to go the high yield route, and we decided to not do that and rather go the private capital route because we could structure something that was much more flexible, that allowed us to continue to grow the business that we were working on without having to focus on some of the restrictions that we would have had if we'd have gone the high yield route. So it's not something that has been an either or. We actually, in that case, used it in conjunction with the bank financing. So that private capital market is another tool that we've got in order to exercise our acquisitions.
We've got a chart here that will show us the exponential growth in private debt capital. While we're bringing that up, Adam, you are both a consumer and provider of this kind of financing. How has that changed your business?
I think the trend that Alex has identified is one that we're seeing, where you're seeing not only the formation of very large liquid pools of capital in the syndicated markets. If you look at CLO formation, for instance, in the last 2 years, it's actually been higher than what it was in 06 and 07. But you've also seen this robust private capital market be created over the last decade or so. What we find to be a big trend, though, is the convergence of those two markets together. And what's going on when we finance our own portfolio companies in private equity, or when we approach other sponsors to finance their portfolio companies as part of our credit or capital markets business, is the ability to marry both the private credit solution and a broadly syndicated solution, the same conversation, can really create a competitive advantage in financings. And there's instances where, for instance, 20 of the last 23 deals that have been done in LBOs with second lien financings have all privately placed the second lien, as Alex has done. You may do that because you want to de-risk the execution of the second lien, which is the harder part of the capital structure, and optimize your pricing on the first lien. It can provide momentum in a transaction, and it can facilitate deals that otherwise wouldn't be done on a fully underwritten basis by a bank in choppy markets. So that's a big trend. The other thing we're seeing is if you go look at the last decade, it's been punctuated by a number of credit dislocations. 15 and 16 was a particularly extreme period in the United States with the energy and sort of retail markets collapsing. People were still able to get deals done in those cases. We at KKR financed an acquisition of Millsweet Farm. We went to 25 banks, couldn't get a bank commitment because markets were closed. We hit the private credit markets and were able to get a deal done. And so the private credit markets are also creating a little bit of a shock absorber when you do see these periods of disruption, dislocation.
Susie, does it worry you, though, that says something about where we are in the cycle when 25 banks can't do a deal or couldn't do their deal because of risk factors, but somebody else comes in and provides that capital anyway?
I mean, I think the period that Adam's talking about was a period of credit market disruption. We always have those. And I actually think it's a great sign that when markets are bumpy, there are alternative investors who can support the market. More investors, real investors with deep pockets and the ability to invest through the cycle. It's better for us as well. So it does not concern me. I don't think this is a folks that are fast money chasing bad deals. These are real funds. We have our own private credit investing group. We actually have two. So very, very supportive of the development of that market.
Yeah, I think the important thing to keep in mind there from my standpoint is that it's options. And there's a different reason for using a different tool. So you no longer have to use a hammer when you need a screwdriver. I mean, Susie's model is definitely not going away, and it's very important to have the banks and the institutions there that can provide a certain type of financing support. But there are alternatives now. So when you need a different, I don't want to say more thoughtful because that's condescending and that's not correct. But when you need a different type of structure because of the business that you're looking at, whether it's because you need some flexibility in the short term, whether you need a different a mechanism built in, there are a lot of different alternatives you can get from the private capital markets versus the institutional market.
And I think one of the things you're seeing happen as a result of that, when you have more options to finance yourself in more different ways and more things to combine, your options become endless, and consumers of capital, and you see this across private equity firms, have started to internalize teams and capital markets businesses whose job it is to go kind of mix and match their financing structures together to optimize your capital structure, cost of capital, improve certainty of execution, de-risk your transactions. And that's creating sort of this virtuous circle where consumers of capital are being more responsive to changes in the market, and the market is being more responsive in developing new products to bring to the market, and you can kind of start to mix and match, as Alex has done, for instance, when they acquired Zayo and they mixed a private credit solution with a market solution to get a big deal done.
So you guys are really smart investors. You're assessing your risks, right? But a lot of little funds have sprung up in the private debt market. Why shouldn't we be worried about a bubble at that end of the market?
Look, I think that's a great concern, actually. As a firm, we have a $24 billion private credit business. We've scaled it massively in the last 10 years. Our view is that you want to go to where there are fewer people. In the large end of the market, there are fewer people that can write checks of $1 billion, for instance. And as a result, term structures and other kind of credit fundamentals tend to hold better at that end of the market. And so we actually purposefully try to steer ourselves to those places. And I think the flip side of that is smaller credit firms or people that have to compete in smaller deals probably are going to find themselves in a riskier part of the market, which is fine today, but as things turn, things could change.
Are you seeing some of that? What's some of the craziest behavior that you've seen in the market?
I think we've seen in some markets people preempt debt deals. You hear people about preempting a private equity transaction. Some people say, or preempt the debt deal, here's our package before they've done due diligence. That kind of behavior is pretty risky. There's a lot of great firms out there. I'm not particularly concerned about credit managers exercising poor judgment. But when markets are overly competed or overly capitalized, you do run the risk of people reducing standards to stay deployed.
As a side note, I haven't found those guys yet that preempt without doing due diligence, but I'd be happy to
We're on the
take a
lookout.
reference if you have it.
We're keeping those a KKR as our competitive edge.
So how are you guys assessing the risk?
Look, when we
As a lender.
I think in the same way probably Susie does. Fundamental credit quality is an important thing for us to focus on when we're providing capital, whether it's off our balance sheet for distribution or whether it's for our private credit funds. Structure matters, terms matter. These are things that you can't compensate for by just charging a little more money. They're fundamental issues. And so I think also the thing you look at is in tougher markets, the higher quality companies, the better credits are going to be the ones you want to surround yourself with, and you want to avoid typical things that are going to be challenging from a credit perspective. What do you think?
I think leverage has crept up a little bit. Pre-crisis leverage in the loan market, I think, was 5.2 times. It had crept at one point to 5.7 times, back down to 5.5 times. But same story. We want to think a lot about terms in the market. It's interesting in a market like this that's been somewhat bumpy, but terms have not adjusted yet. And so, deals that we underwrote last week or the week before, those have terms that were a function of the markets the month before that. And we'll take a little pause here, and if things remain bumpy, we'll push for things that we need, like greater flex rolling into a more complicated market. And I think, for the most part, other folks who are underwriting side by side with us, which we do with KKR Capital Markets all the time, we'll be thoughtful about it. And nobody wants to end up in some sort of like credit accident. And we don't know. We think this is just a bumpy period, but we don't know if it extends further.
And those financing commitments are meant to withstand time, and so there are provisions in the documents like Flex that allow you to adapt to changes in markets. I went back yesterday and was looking at some of the terms that we were getting in the pre-crisis vintage. Yeah. And we were looking at 8 to 10 times leverage. We were looking at 25 to 75 basis point flex. Commitment periods were expected to be 9 to 12 months. Now we try to get off risk in 30 to 90 days. So the market is just in a much different place than it was pre-crisis. And so while you can talk about leverage looking high, people talk about 7 times today is high. That's very different than it was before. I think you also look at from like 2016 to 2018, the number of deals that are on the outer edge of some of the credit metrics, like 7 times or 1.5 times cash interest coverage. Those numbers have also trended down. So I think there's still a level of responsibility and prudence in what people are doing. And if you look at that relative to where we were, call it a decade ago, I think you look and you say you're in a pretty good place.
This duration point is really important. Yeah. We were actually talking about this yesterday. We have an expression that we're in the moving business, not the storage business. And while during the crisis we were in the moving business as well, it was going to take a long time to move. And this velocity of turnover of the book is really, really important. The ability to de-risk quickly, and that's happening. The other thing that's different now versus 10 years ago is just the total notional amount of loans on folks' books. It's 10 to 20% of what it was pre-crisis.
And the capital formation is only increased, right? So
Exactly. We do have a chart that talks to your point about leverage and the fact that we're not at pre-crisis levels by any means. But Brian Moynihan yesterday, the Bank of America CEO, was talking about a potential carnage lurking in the leveraged loan market. I'd love to get your thoughts on that. We do have a polling question actually on that too. So if everybody could get your phones out, it's the Bloomberg invest.app. Love to get your thoughts from the audience about what you think. So once you've got your phones out, and the question is, Bank of America CEO Brian Moynihan says there's potential carnage lurking in the leveraged loans market. Do you strongly agree, disagree, strongly disagree, or agree? Wow. So we think he's right there? So big in favor or agree, right? Numbers are still coming in. We've still got, nobody strongly disagrees. So we're at, so most people are saying we agree as the numbers are coming in. Thank you for participating. Love to get your thoughts, panelists, on that.
I mean, I guess I'm surprised a little bit that I don't know how, potential carnage. It's a couple of makes it difficult to quantify. I mean, I think from the equity side, one of the things I'd say is that a little bit of a difference versus pre-crisis is that we're probably a bit more aware of it now from an equity standpoint, and I think also from a financing standpoint. And to your point, I mean, I don't think we've really seen leverage levels even getting close to, I don't know what the macro data says, but the leverage levels getting close in the M&A market to what we saw in 6 and 7. I mean,
so you'd like a bit more leverage for your deal?
Sorry?
Would you like a bit more leverage for your deal?
Yeah, please. With no covenants would be great. But we haven't seen nearly those leverage levels. But notwithstanding that, we still are taking an approach right now that is, let's future-proof our companies, not only from the standpoint of digitization and ESG and some of the stuff we worry about on an equity side, but also from a capital structure standpoint. And so using some of these different tools, we're able to set our companies up so that we believe that they can still continue to succeed even if there is a crisis that occurs. So I probably, maybe I'm biased just because I see one portfolio, but I'd probably be a little bit more in between the agree and disagree than I would be towards the upper end of that scale.
You're going to sit on the fence?
I'll take the disagree. I'll go with that. But I'm biased because I only see one portfolio.
Yeah, to me, it's, what's the definition of carnage, right? It wouldn't be called the leverage loan market if there wasn't some risk associated with it, right? Otherwise, it'd be the investment grade market. And so, some loans will default. Their investors are earning higher returns for investing in more levered credits. And I think the question is, back to terms and structure, do we have some protection? How exposed are the banks? And how interconnected are the banks, right? To me, carnage is a crisis that spills into the whole system, becomes systemic, takes down other markets. So that's why I would disagree, or somewhere between disagree and agree, but there will be loans that default when the economy slows massively and companies make less money.
I'm in the disagree camp, and I think the 74% probably has a lot of Bank of America employees dialing in on this one. Look, I think if you actually go and look at it, during the entire financial crisis, there was a 1% default rate on leveraged loans, and you had the same amount of CLO formation you had then that you have today. I think the point is CLOs are actually very resilient instruments, and they can withstand. They're built for duration. They don't have any mark-to-market triggers in there, and they turn off cash flow to the junior parts of the securitization if performance isn't there. And what you're putting in a CLO is actually first lien security on a highly levered company relative to IG, but it's still a fairly appropriate part of the capital structure. So I don't particularly see there would be a lot of carnage. I think if you look at a lot of the metrics and a lot of the lessons that were learned, that's been reincorporated into credit fundamentals. And so I'd be in the disagree camp for sure.
Susie, of the loans that you think that might be at risk of being in trouble, running into trouble, what proportion of the market would you say that those would be?
I mean, back to Adam's comment, it's a small proportion of the market, and the market's just not that big in terms of, in terms of banks holding stuff on balance sheet that could default, immediately. I mean, there's also, a pretty robust workout market, right? And so, is there a certain amount of pain? Yeah, but recovery is pretty high on these things.
Yeah. Where you may see some trouble is some CLOs are starting to invest in smaller deals that are less liquid. And those can be fine if you're holding them to maturity and you don't need to move the paper. And if you have reasonably good credit qualities for smaller companies. But that's where you could see maybe some issues. I think the bigger capital structures tend to be the more resilient capital structures. And look, we got an entire financial crisis to watch that. And if you really look at the financial crisis, it was actually a mortgage crisis, and the contagion of the mortgage crisis created a liquidity crisis that then compounded with some of the backlog in the leveraged finance market that created strain. And it wasn't the actual fundamental performance of leveraged loans, and it certainly wasn't the fundamental performance of CLOs that was the problem.
Susie, when we talk about mitigating risk in financing of deals, one of the things that's really holding up deals at the moment is this rising nationalism, rising protectionism, and that has really pushed out deal timelines.
Right.
How are you sort of protecting yourselves against that?
Listen, from a bank perspective and regulatory risk, when we underwrite a loan and we think about terms, we think about how long that loan might be on our books. How long before the deal closes, or in the investment grade market, the bridge gets taken out in the bond market. And so I think terms appropriately reflect the possibility that we might be in a bridge loan for quite some time. Companies are thinking a lot differently about how to mitigate regulatory risk in their deals, and we've seen a real increase in the use of deal contingent hedges, either around interest rates or around FX for cross-border deals. So in those transactions, a company would buy an option to hedge their fixed rate on their eventual takeout, or to hedge the currency risk in the purchase price of the deal, and that risk would be that the payment of the premium on that option would be contingent on whether or not the deal closes, and then Goldman Sachs or another bank would take that risk, and we risk manage that transaction or that option ourselves. And there's been a real increase in that as a function of this uncertainty around regulation around the world.
Alex and Adam, would love for you to jump in here too.
Yeah, I mean, I'd agree. Look, there are a couple of risks there relative to execution that are related to regulatory that are different from sort of the managing of the ongoing business. And we generally treat those risks the same regardless of what they are. Think about how we can mitigate them and the cost to mitigate them versus the risk itself. And the FX hedging for cross-border transactions is one of the things we probably utilize the most. The deal contingents are tough, but or at least from our experience, but it's also, that's more of a consideration, I think, relative to whether or not you want to pursue something as well, if you've got major concerns about being able to actually execute it.
We regularly use deal contingent hedging on foreign currency and rates as part of our transactions, and it's a great market. We have a specific person that does derivatives and hedging just for our entire portfolio, and so we're frequent consumers of that, both on the buy and the sell. And
you're using it a lot more than, say, you were doing 5 years ago and 2 years ago?
I think we're absolutely more sophisticated in terms of using hedging than we were 5 or 6 years ago. I think part of that is just where we are in terms of our evolution as a firm. I think part of it is the market is there, and we have great partners at banks that are willing to sort of help intermediate that risk for us.
And I think 5 or 6 years ago, the sponsors were using these transactions. They're using them more. The strategics were not. So I think that's really the big change, is that the strategics have gotten more sophisticated around using, hedging around these transactions, and then also more concerned about the risk of close.
Speaking of risk, I guess it kind of brings us a little bit back to the topic of our discussion today. It's not about baseball, but what inning would you say we are in, and do you think we are on borrowed time?
Looking at me.
I'll go
I don't like
to
the
go
inning
first.
question. You go first.
I'll go first. I thought you were going to ask, it's the ninth inning, what's going to happen? And I was going to tell you that just because it's the ninth inning doesn't mean the game's over. Game 3 of last year's World Series went 18 innings, had 561 pitches, cycled through like 46 players. You wonder who the 4 guys that didn't get a play are. And it took 7 hours and 20 minutes. So
see, I knew Adam would have all the baseball stats. That's why I let him go first.
I was ready to go.
Halfway through.
But I think what it means is that, while it feels late cycle, and if you go look at the data, probably corporate earnings and auto seem like they're late cycle. Mortgages as a percentage of GDP bank leverage seem more mid-cycle, and the consumer seems healthy. So I think it's set up to continue for some period of time. When we as a firm look at what risks we're expecting, it's probably going to be more sector recession risk, like you saw in Europe in 2011, like you saw in energy and retail in 15 and 16. Whether that's going to be driven by trade, whether it's going to be driven by antitrust concerns around tech, it's unclear, but it should be more focused and less of a systemic kind of big malaise or shock like that. And that's how we're kind of thinking about our business.
What are the sectors that are flashing warning signs to you?
Look, I'd be focused and concerned about anything that has major trade components to its business. I mean, some of the overnight, 70% of your business can go away because of a tweet. I would be focused a little on some of the areas that are more cyclical, or that you have more single name commodity kind of exposure to them. It's probably where we're staying away from.
And you guys aren't off the hook yet?
So I'm with Adam. We could be in the ninth inning. We could be in the seventh inning. We're obviously not in the third inning. I mean, that would be the longest, bull market and the longest period of economic growth in history. But I do think that if we can sort out some of these headwinds, i.e., trade, we've got a way to run. The consumer's in good shape, companies are in good shape. And the other thing that I think is pretty interesting is, when this, we will see, I think, a reduction in GDP growth if this trade thing drags out, right? But then we see the market and, frankly, the Fed responding to ease and create, and the market's eased first. The Fed, people are thinking maybe the Fed's going to ease right now. My opinion is they're not, but the market's eased. Okay, so rates are lower. It's it's kind of it's just economic math, right? Rates are lower, so companies' interest cost is going to be lower, and maybe people do jump into the financing markets and take advantage of that, and so perhaps the trade headwinds will cause them to make less money, but they'll be able to, finance at lower rates and put that money to work. And so I'm cautiously optimistic that we are in one of the later innings, but we have a race to run. I'm going to go get another hot dog and a beer.
How about you, Alex?
Yeah, it's interesting. I mean, if you didn't know it was a 9-inning game, then it'd be a little bit easier, right? Because if it weren't for the fact that we were in a long bull cycle right now, I mean, if you just drop down into today, you wouldn't feel that bad about life, I don't think. I mean, okay, growth in Europe's a little bit stagnant, but the U.S. is doing okay. We've got a few major generational type of trends that are going on right now, whether you want to believe in digitization and sort of what that means for productivity, or if you want to believe in the rise of the middle class around the world, or all of the different things that are making us more interconnected as a global society. I mean, notwithstanding some of these trade blips, and I personally am a believer that all this stuff is going to sort itself out before an election year. I'm not exactly sure how, but I'm pretty sure it will. So, as a point in time, it's not that bad of a place to be. So if you didn't know that you had already been through 7 innings and that this was a 9-inning game, it would feel to me like it's a lot more. We're in the 3rd, 4th, 5th inning now. We haven't even changed the starting pitcher yet. So it's an interesting time. I think there's some good dynamics out there. I think there's some very strong sector drivers that are going to make, maybe to your point, that there are going to be some sector specific pullbacks, but there's some very strong top level trends, some very strong sector drivers, and I think it's a pretty good time right now.
Thank you so much.
And the comment on digitization and productivity, that sounds like maybe it's played out, but I don't think it has. There's some really exciting young companies out there, and even we old companies are doing things in a different and interesting way. And I won't delve into the our strategy and our growth strategy, but I'm pretty excited about the businesses we're building that are digitized at Goldman, and my clients are doing the same thing. So I really think you could see the curve push out still because of technology. We may actually be in the 3rd inning from a digitization perspective. In fact, we might even be in the first
I think we're
inning.
earlier than that.
Yeah, exactly.
I mean, less than 10% of the digitization opportunities out there have been taken advantage of. And I don't mean from a company standpoint. I mean implementing, simple stuff, ERP, and the way that you can automate back offices, the way that, and that's not even getting to the commercial side of the business where you can use it to integrate with your customers and have a much different relationship. So I think we're in the first or second inning of a major trend.
Agree.
Okay, well, I better stick to M&A and not go waiting for the credit crisis. Thank you very much, Alex, Susie, and Adam.